I was at Costco the other day and I was going through the avocado aisle and I noticed that the prices were at a seasonal low of around $8.30 for the 5 pack of non-organic avocados. That had me looking at what is going to be the impact of tariffs on my avocado budget because it's a significant portion of my own personal expenditures. I was looking at the avocado board data and we're in an interesting period where we're in the middle of peak California avocado season. So we're not going to be seeing any of the tariff stuff. But what I'm worried about is in 2 months, the California avocado season ends, and then we're all on in Mexico, Peru. Those are going to be the main importers. So I'm watching closely whether those tariffs will impact my budget on the avocados.
Well, now I'm really disappointed. The solution to tariffs on avocados is really to grow your own. As you know, my dad is a hobbyist avocado farmer and an enthusiastic one. He's got 4 different species, varietals, different types of avocados,
Yeah, different flavors. I'm going to go with that.
different flavors. He's got at least 4 on his property in Southern California where it just gets hot. And what he'll do is he'll send us occasionally these softball-sized avocados in the mail.
So that's my dream. If you've looked at my cash flow prioritization, it always ends with avocado orchard. And the dream, a little challenging in San Francisco right now in a rental, but eventually I'm gonna have a place where I'm gonna plant my own orchard. That's like the end fire goal. On the prioritization list, it's once I max out my taxable brokerage account, so it's gonna be a little bit challenging. They keep letting me put more money in, but I figure we'll get there. Hopefully that intro is enough time for people to trickle in and we can dive into the initial topic on RSUs and vesting. Because I know I've already been getting a lot of messages. RSUs are very top of mind. One of the main reasons being for workers that are at these companies is oftentimes they're going to have blackout periods, and those blackout periods typically open up like the day after earnings if they're subject to any blackout periods at all. I know most of FAANG has blackout periods. Blackout periods are going to be the periods of time when you're not able to sell your own company stock, regardless of whether it's from RSUs or otherwise. You're just kind of prevented from selling, both you and your spouse, for preventing from any insider trading, making sure everyone's operating off of the same information. Not every company has that, and depending on your seniority and your access to information, you might have different blackout dates. At Meta, it was kind of broad across everyone outside of the folks that worked directly on the equity team and the financial team. Everyone on those teams needed to have prior approval for any trades or set up trading plans.
Before we start talking about this stuff, there's one more thing I wanted to put on everybody's radar, which is the disclaimer. So we have to be clear that we're not providing financial advice. If you're tuning in or watching us here, then just know that you want to seek the counsel of a credentialed advisor if you want something tailored to your situation. So what we're talking about here is general in nature, and just wanted to be upfront about all that.
Yep, this is the Not Advice podcast where the disclaimer is partially in the name. Everyone's individual circumstances are different. Always seek a certified financial professional as you're making these decisions that can have the full understanding of your entire circumstances.
You know, Andre, it sounds like you've practiced that. You've said that a couple times.
Yes, I am not a certified financial professional. I am not a advisor. I'm a ex-tech employee, marketer, analyst, product manager, growth person who just really likes spreadsheets way too much and got super into this stuff. And that's the perspective I'm coming from. I'm not coming from someone who's read about these topics in a book. I'm talking about things from my own personal experiences. And that's all I'm going to be able to speak towards, things that I'm personally familiar with and have personally gone deep on because I've had to personally deal with this. Whenever I'm talking about this topic, I have to say this over and over and over whenever we're talking about RSUs or restricted stock units. Today, we're going to try sticking with public RSUs, primarily at the FAANG-esque companies where employees are getting equity on a regular basis. That's kind of the context that we have. And then more focused on US taxation. I want you all to remember that RSUs are part of your compensation. They are taxed as income at the moment of vest, regardless of whether you sell or not. RSUs are taxed as income at the moment of vest, regardless of whether you sell or not. I can just say that over and over and over because every single time I talk about this topic or talk about this with someone, more people learn about it. So I have no qualms with being repetitive. So if you're someone who sees my content over and over and is like, this guy's pretty repetitive, he says the same thing over and over, that's the intent. I want you to think about, whenever you think about RSUs and FAANG, be like, I want you to think about Andre, and I want you to think about him consistently saying that RSUs are taxed as income at moment of vest, regardless of whether you sell or not. I just want that to be an immediate association that you have. So I will keep saying that, and I will be a broken record. So what does that actually mean for RSUs to be income at the moment of vest? So from a tax perspective, whenever you receive RSUs, you'll see a $0 pay stub in your payroll provider. At Meta, that's over in Workday, you'll see $0. And if you click into that, you'll see your entire vest details, where it's going to show the dollar value of the vest at the moment that it happened, as well as the amount that was automatically sold off or withheld to cover for taxes. And it's treated as income. One of the key distinctions there is it's withheld at a different rate. So people incorrectly assume that, hey, it's the taxes when I'm receiving these RSUs, the withholding rate that I'm seeing on these pay stubs is different than my normal paycheck. So it must be different. It's taxed at a lower rate or something's going on there. And that's just not true. What ends up happening is for RSUs, they're withheld at something called the supplemental withholding rate. And by default, if you're making under $1 million per year from non-equity sources, by default, that rate's going to be 22%. And 22% at the federal level is actually way too low. If you're single and make more than $100,000, you're already in the 24% tax bracket. If you're married and making over $200,000, same thing, you're in the 24% tax bracket. So what ends up happening is, as you're starting to earn more of your income from RSUs, and maybe you're making $500,000, which is not crazy for someone at a FAANG, and $300,000 of that might be coming from RSUs. So $300,000 of that, it's only withheld federally at 22%. That delta between that 22% and your actual marginal rate, which might be in the 30s, that's going to start building up a nice under withholding that you'll learn about when you do your taxes the following year. If this is your first year where you're receiving a significant portion of your income in taxes and you haven't made any adjustments to your supplemental withholding rate, just know that you might be in for a little bit of a tax surprise come next April. There's
one thing that always comes up, and it's right at vesting. And that's just like, how much income am I receiving? And so you've got the current fair market value of the shares versus the grant price. So the price that you were awarded them, and it could have been years ago that you were awarded these shares. And maybe you could talk just a little bit about, is it the grant or the fair market value that I'm being taxed at when these things vest?
No, definitely. So let's say that you're joining a company. Like typically what will happen is you're getting a offer of base compensation, bonus, and then some amount of equity. And depending on the company, they'll position differently. But oftentimes they'll say something like, you're getting $400,000 of equity vesting over the next 4 years. And if you're at a company like Meta, what will happen is that $400,000 when you're joining, maybe over the next like month or two, the value will be based off of the average stock price of the month right before you join. That $400,000 is going to be divided by the average stock price in the month before you vest. And that's going to be converted to number of shares from that point on. So then now that grant number is no longer relevant. That $400,000 is now meaningless. It's been translated to a specific number of shares. And that's the only thing that matters from that point on. So now over the next 4 years, at Meta specifically, it's going to vest every quarter. You essentially can divide that by 16, that whatever number of shares that ended up being, in equal buckets. 1/16 of that amount every single 3 months is going to be vesting. And the amount that counts as income, it's going to be entirely dependent on what the Meta stock price is. So if Meta stock price is, I don't know, right now it's around like $700. So it's going to be $700 times however many total shares that you have vesting. That's going to be how much is going to be treated as income at that amount. So you can completely throw out the window what your initial grant price is. It's essentially meaningless.
It's like
at the moment
planning.
of when you're negotiating. It's like when you're negotiating and like the initial thing, it's like now translated into shares, and the shares is now what matters. And that's why I spend a lot of time making dashboards around tracking my own total compensation. I've made all those public because your compensation changes so much, particularly as you get more senior in your career. More and more of your income is going to be coming from RSUs. And on a day-to-day basis, it seems like those are swinging at pretty significant amounts potentially, especially over this last couple years. You've seen regular 30% swings, both in the positive direction and negative direction. And if a big chunk of your income is coming from those, that directly impacts how much income you're going to have coming in. So again, from an IRS perspective, it's translated to income at vest. So that's going to be the number of shares that you have vesting at that date multiplied by the price on that date. So Meta, as another example, as I'm most familiar with, typically those are vesting like August 15th is going to be the next vest date. So whatever business day was before the 15th, the closing price of that business day before that vest date is going to be the dollar value that your RSUs are going to be based off of and counted as income. So if you have 100 shares, it's going to be 100 shares times whatever price that Meta was on that day before your vesting date. And what ends up happening is you're going to say like, all right, Andre told me that my RSUs are taxed as income. They're only going to be withheld at 22%. I'm going to go look and see how many shares I have landing in my brokerage account. And hey, like, what's going on? I only see like 50% of the shares. Where are the rest of them? I thought only 22% were going to be auto sold. And then this is where I need to remind people that federal taxes are not the only taxes that exist. There are many other taxes from Medicare, Social Security, depending on how much you've earned so far this year. And if you live in a state like California or New York, there's also those little state taxes that end up digging in. And it might be very common to see 50% of your RSUs automatically sold to cover taxes. And also that might not be enough because that still doesn't factor in the amount that's going federally, which is, again, that's the piece that is oftentimes under withheld. So that's generally how it works. There's some other like more detailed mechanics. So you have like the vesting day on let's say August 15th, which is super common for people at Meta. And then so that's considered V day. Then you have like the vesting day plus one. The shares will physically be deposited in your account. So that's the day after your vesting day. That's oftentimes the first day you can physically sell the shares. Oftentimes the cost basis won't be loaded in yet. And what that means is if you have multiple lots from past vests, you won't be able to see like the gain loss on that most recent vest. You can still sell the most recent vest. You just want to make sure you're making adjustments to change the default selling mode to be last in, first out. So oftentimes the default is first in, first out, which will sell your oldest shares. And odds are, if you've been working out a FAANG for a while, you don't want to use that first in, first out. It's going to be the lot with the highest tax obligation.
In general, there might be some wild circumstances where you've got short-term losses where maybe it makes sense to sell some newer ones or something. But in general, you want to be, I get maybe your broader point is like, you want to be deliberate about which lots that you sell.
That is the key thing. Particularly if you've been at a company a while, you're going to have lots that have vested over many different prices. Again, almost all the FAANGs, particularly if you've been there since like 2020 or earlier, you've seen some crazy swings over that period. So you're going to have vests from all over the place. And the amount of taxes are going to be different for every single lot, depending on the gain since the vest happened. So that's the next key distinction is RSUs are taxes income at the moment of vest. And if you sell them right away, there's oftentimes no additional taxes because what ends up happening is you're only going to pay more taxes on if there's a capital gain. So that's the difference between the price that you sell it at and the price that it vested at. So when you sell your most recent vest right away, in those coming days right after the vest, there's oftentimes not that much of a fluctuation in the stock price. So when you sell it right away, it might even be a loss. So if you're selling right away, you're essentially not going to be taxed again. That's like one of the big common misconceptions that people often have with their RSUs is I'm being taxed twice. Every single time I receive my shares, I'm getting taxed as income. And then when I sell them, I'm getting taxed again. You're only getting taxed the second time if there has been a gain. So if you're selling your new vest right away, odds are the amount of the gain, if you're within a couple days of the vest, it's not going to be that high. So that's why you'll often hear financial advisors and many other financial professionals tell you is you want to treat your RSUs the same that you would treat a cash bonus. So if your company was giving you a cash bonus, would you use that cash bonus to buy company stock? Because from a tax perspective, it's the exact same thing. If you decide to hold on to your RSUs, it would be the exact same thing as you getting a cash bonus, that same amount, and then turning around and using that cash bonus to buy company stock.
This is a really powerful point. There's like such a like interesting nuance in here that I think people don't really view it this way. And I think it's interesting to surface, which is that when you join a company and a large chunk of your compensation is shares in the future prospects of that company, you're essentially taking a long bet on the company in addition to your salary being attached to it. So you are long that company beyond just the fixed income payment that is your salary. But now we're talking about tax mechanics. I just wanted to call back, to eventually we're going to transition to like, hey, why does it make sense to sell at vest? And there's a reason is that you're already exposed to your company. And do you want to keep on adding exposure? And one way to do that is if you got a cash bonus, would you keep on buying shares? Just like you're saying, Andre, would you keep on buying shares? And it's like, most people would not, some would, but most people would not keep re-upping on their employer just because they're already exposed to their employer via their employment. I think people forget that.
In Q1, many tech employees get cash bonuses. Oftentimes, these cash bonuses line up pretty closely to when one of their vests are. That's an excellent moment for you to self-reflect on. In Q1, I received a cash bonus and a vest. Did I use any of my cash bonus to buy more of my company stock? Very rarely has anyone ever told me that, yes, they've used that cash bonus or they're using some of their normal pay stubs to buy more company stock. It's hard to reconcile that in your head because from a rational perspective, there's no difference between cash bonus and RSUs, but something happens in our head where we treat them different. I don't know if it's like the endowment effect where you value things that you have more than things that you don't have, or if it's just FOMO where people have been rewarded by potentially doing nothing. And it's really hard to take an action and then see other people benefit for having done nothing. And that action that you physically have to take, I think that's one of the things that also prevents people from acting on a purely rational basis. And some people get a little bit offended when I'm saying like using the word rational because it implies that they're not being rational. And I don't think that's fully correct. What I'll tell people is I don't think there's anything wrong with people holding their company shares and being over indexed on their own company. And again, like Brent was saying, you are by nature of working at this company, you're going to be benefiting from the company doing well, both from your direct employment and if you have other RSUs vesting in the future, if those continue to do well, your future compensation will increase. Just remember, you're already over indexed on your employer. But specific to whether you should hold your own company shares, I know we're going to talk about over indexing later on or concentrated or holding too much stock, but this stuff's all intertwined. I think it's a really good topic to kind of discuss. What I tell people is if you want to hold some of your company stock, awesome. Physically write down what % of your overall investments or net worth do you want to be attached to your company? Is it 5%? Is it 10%? Is it 20%? Many advisors will say more than 5% is concentrated, more than 10% is very concentrated, depending on an individual's risk tolerance and all these other factors, depending on how much income you have or how much your existing investments are. But remember, like physically write down that number because what ends up happening is when you're so concentrated, particularly in a company that has experienced a lot of volatility where like in any given year, maybe it's up 100% even depending on the company, it's not unheard of, is that 5% that you wrote down quickly becomes 10%. And if you physically wrote it down, it's just easier to stay a little bit disciplined. And the other thing I'll push back on is like, hey, I want to, if you want to hold your shares, again, perfectly fine. But what are the odds that this random amount that's vesting based off of this random price that was given to you when you were first hired, or maybe you got some refreshers that was translated into number of shares and multiplied by the current stock price is a specific amount that you want to hold. So that's the other thing that's like, okay, awesome. You want to have more company shares. Why this amount that just happens to be this random number that the company decided to give you? So that's the thing that I'll push back on. So I was at Meta for 10 years. Almost every single time I sold immediately on vest because I asked myself that question. If Meta gave me this money in cash, would I use that money to not buy Meta? And those times that I didn't, most of the time I just forgot. Like things get busy. And when you have a 15-day window between the vest and then the trading window closing, sometimes life gets in the way and it happens and it's not a big deal. But for the most part, I've been very consistent on selling on vest as much as I can with my Meta shares over that entire 10 years. And when I joined Meta, I think my initial grant was in the 60, so $60. So if I would have held, would I have more money? Yes, definitely. No question. I've actually done the analysis. But I think the key thing that prevents people from selling is, do you have a plan of what to do with it when you do sell? Most people don't have that plan. And if you don't have that plan, then you have the hesitancy where, I don't know, like that money would just sit in cash and it wouldn't do anything. So this coming up with a plan ahead of time. So now, let's say that your vest hasn't happened yet. Like start writing a plan now so then you can act on it when the vest actually happens. So for me, my plan was always, I'm going to sell on vest and treat it like it was any other cash that I would be getting from my employer. What does my own internal cash flow prioritization say that I would use any other cash for? And in most cases, I would kind of go back and be like, all right, have I maxed out my 401k? Have I maxed out my mega backdoor? Have I maxed out my normal backdoor? And if you don't know what these terms mean, like we could chat about those later or another topic or kind of like look them up. But essentially going through my prioritization list and then ultimately getting to, all right, I've maxed out my mega backdoor Roth, which at that point you've already contributed $70,000 into your 401k if you're doing that. And then I would say, okay, I still would save more. I would then go and add more to my normal taxable brokerage account. So that's a boring brokerage account that you can have at Schwab, Fidelity, Vanguard, or any other institution. You can even use the institution that your RSUs have vested at if you don't want to have any additional complication. But I always had a plan. It was like I would treat it as any other cash and I would invest it and diversify it as I would any other cash that I receive. So for me personally, I had an outline of like, hey, my personal asset allocation is, I don't remember off the top of my head, but let's say it's like 60% US, 30% international, 10% bonds. Like that's a average asset allocation that I probably had going into my mid 30s, where maybe I've adjusted it now to be a little bit more conservative or heavier on the bonds. But for the most part, that 10% bonds, 60% US has held. I would just turn around and be like, all right, what's my current asset allocation? Awesome. I have new cash. What do I need to buy? And if it was in my taxable account, most of the time it would just be more VTI for my US portion or maybe VXUS for my international portion. And again, this is not a specific recommendation. This is just what I've personally used. My philosophy has generally been low fee index funds. More recently, I've taken up some more advanced strategies around direct indexing. But for the most part, if you're just getting started out, keep it boring, have a plan, have a specific target of what you're trying to do with your money, and then you can go on autopilot. So if you're forcing yourself to make a decision every single quarter, you're just giving yourself extra work and extra mental load. But if you have it written down where I'm going to sell, automatically invest, I'm going to buy X, Y, and Z based on my asset allocation, then you don't have to think about it.
Let me throw a wrench in this because I think this is an interesting exercise. So you've received, like, imagine you've received a cash bonus, just like you're saying, Andre. Would you proactively choose to reinvest in your company? And again, most folks would probably say no. What if there's a discount on those company shares? And this is a very real thing known as employer stock purchase programs.
Yeah.
And I've had this marketed to me as an employee years and years ago. I've been independent for years, but before that, it was like, hey, look, we're going to give you this 15% bonus on company shares if you just go ahead and plow your cash bonus back into the company and look at what the benefit is after tax. Even if you were to sell, after a full year of holding, would you do it in that case? And I'll say, personally, I never took them up on it. I was done with company exposure beyond my employment, but there are little teasers out there. Let me get your thoughts on that first.
The ESPP is like the details matter. So with an ESPP, so the Employee Stock Purchase Program, you're able to buy up to $25,000 worth of your company's stock, and potentially there's a discount, potentially there's a look back period, and potentially there's restrictions on when you can sell. All three of those details matter significantly. So let me use Uber as an example because that's the one I'm most familiar with. So Uber has a 15% discount on their ESPP where an employee is able to contribute up to 15% of their income up to that $25,000. And that $25,000 will get multiplied by that 15% to reduce the amount that you can contribute. So you can essentially buy Uber stock at a 15% discount, and it has a look back window of like maybe up to a year, depending on the specifics of when you initially enrolled in the ESPP. If you've looked at how Uber's stock has performed over the last couple of years, that 15% discount quickly can turn into like a 50% discount. And all of a sudden, we're talking about potential free money if you don't have any restrictions on when you could sell it. If some companies I've seen have restrictions on, like you have to hold it for at least a year before you can sell it, Uber doesn't have that restriction. You're able to sell right away. Some people get a little bit hung up on there's different tax implications on when you sell. So I'm not going to get all the details right here, but I'm going to quickly gloss over it at a high level. But essentially, that the way that taxation on ESPP works is people incorrectly think that, oh, I need to hold it 2 years to get a tax break. And yes, that's true, but you can sell it right away and you will be taxed right away, and that discount will be taxed as income. That's still going to be an instant, like instead of 15% free, or if in the case that there's a look back window, instead of 50% free, oh no, I'm getting taxed and now it's only 25% free or 7% free. It's still free. Yes, you're paying taxes on it, but don't be afraid of taxes. I think that's where people often get so hung up on is they're so hung up on avoiding taxes or not wanting to sell to have to pay taxes on it to lock in an instant gain. So yes, it might be less tax efficient to sell right away, but you're actually locking in that gain. And I would view the ESPP, if you could sell right away and there's a discount, and even more so if there's a look back window, I would definitely contribute up to that 15% or that $25,000 if you could sell right away. Now, if there's a restriction on how long you could sell, then it gets trickier. Like I've seen some where it's only a 5% discount, there's no look back window, and you have to hold it for an entire year. Then it becomes a little bit trickier. We're gonna have show notes, something like that.
Yeah, it'll all happen. It'll get done. Hey, Andre, let me give you another one. Okay, so suppose that I saw this recently. First, suppose that you've got a 401k. The 401k is employer sponsored, of course. The 401k needs to be administered by an employer. The 401k investment program includes company shares. Have you seen this before?
Yeah. So I will say that I've never seen this in someone under the age of 40. So I think it was a lot more common in the past. And even Microsoft, I know, had it at one point. I don't think they have it anymore. And then it brings up a very interesting implication, because I've seen some accounts where people have like hundreds of thousands of dollars in their company stock in their 401k. Normally, under normal circumstances, what you would generally say is, hey, it's in your 401k. It's in a tax advantaged account. You can buy and sell that without any implications. But there's that asterisk, I think you're teeing me up for this, around if it's through a specific company stock program and if it's in your 401k, then there's something called NUA. And I will now turn it over to you on the specifics, because there's very nuanced specific tax treatment of these, particularly as you're going into retirement on the tax treatment. And my normal advice of, hey, it's in your 401k, you could sell it anytime without worrying about taxes. There's a specific carve out in this situation. And again, I've never seen this in anyone under 40. I'm curious to hear you explain NUA a little bit more detail, as well as some of the specifics of how they might want to treat that a little bit different.
That's not the direction I wanted to go. What I had in mind, which net unrealized appreciation, these are shares that are held in qualified accounts. Qualified it's a fancy word, but it means like 401ks and other circumstances too. Suffice it to say that there's kind of a way to get out of these positions. The government is aware that people get really heavily concentrated in their employer stock in their retirement accounts and kind of wants to give them a hand in getting out of them. So suffice it to say, there is a strategy for this to happen. But you're right. I mean, the times that I've seen really heavily concentrated positions in 401ks, Microsoft, Amazon, maybe up here. I'm in Seattle, just so everybody knows.
There used to be this company called Enron that maybe the people in the audience are too young to remember, but I think they may have influenced the trend away from holding significant amounts of your company stock as your main retirement vehicle.
Yeah, and Andre, I don't know if you saw this, but on Twitter, Enron's back. Have you seen this joke?
I've seen some of the shirts. I think it was purchased by the same people that are behind the birds are not real memes. So I definitely appreciate some good performance art.
So just so everybody knows, just we can take a break from boring finance tax stuff. Somebody went to the effort of buying the brand assets for Enron. Sort of this completely bankrupt company, financially, but also morally bankrupt company. And it's just like post these bangers just on Twitter, and it's ridiculous.
They've conveniently sold merch. Enron now has merch that you can go buy.
They have launched with quotations around it. They did this big thing where they tried to encapsulate nuclear energy inside essentially a barbecue-sized egg. And I was just like, is this real? And of course, everybody's just like, is Enron back? And no, Enron is not real.
Wonderful artists, like the performance artists. Like, if you haven't heard of the birds are not real, like they're acting as if there's a big conspiracy that birds aren't actually a thing. And it's just a funny rabbit hole to go down, but very good performance artists. And those are the same people that are behind the resurgence of Enron, which I think is hilarious. You weren't teeing me up for NUA, so that's fascinating. In normal circumstances, when you're in your 401k, like we're talking a lot about taxes and like if you're receiving them in a normal brokerage account, like there's going to be tax implications for your RSUs. There's going to be capital gains for your ESPP. There might be gains on the discount as well as capital gains. And that all depends on whether you've held it for 1 or 2 years since the issuance. Like there's a lot of nuance on the ESPP stuff specifically. If it's through a specific program where you receive company shares in your 401k, again, I haven't seen this at all recently. Normally, let's say that you have company stock in that account, but it's not from one of these programs. Normally, you can rebalance at any time within your 401k without thinking about the tax implications. The one thing to be aware of is the wash sales. So wash sale is if you sell stock for a loss and then purchase that same stock with plus or minus 30 days. So it can be 30 days before, 30 days after. Then it changes the cost basis of the new shares based on the amount of the loss that you had. This can get a little bit tricky when you're talking about RSUs, because the act of the RSU vesting acts as a acquisition and can create a wash sale. So let's say that right now your trading window opened up and you sell some shares for a loss. And then on the 15th, you have new shares vesting. That those new shares vesting can very well cause a wash sale if it's within 30 days. And then all of a sudden now you have like that loss isn't gone. The loss is just moved and added to the cost basis of your new shares. So if you sell your new shares, then you'll recapture that loss and all will be fine. Unless you're at a company like Uber and Google that vest every 30 days, then you might end up in a fun wash sale waterfall where you're just kind of stuck until you leave the company in most cases. I have a fun scenario that I've been modeling out where there's just like infinite wash sale glitch where you just wash sale forever until you leave the company, depending on how many shares were part of the original wash sale and then how many shares you're vesting. It ends up getting a little bit messy. So it does change some of the math around capturing losses and gains and company stock. So again, that's more of an issue. If you're at a company that vests monthly and you're trying to capture losses, just know that there's going to be some implications on wash sales and your ability to capture the losses might be more challenging. And I bring this up in the 401k situation is because let's say that you captured a loss in your taxable account and then you go and buy the stock in your 401k for whatever reason.
Oh, yeah.
Now you've essentially deleted the loss and you can never capture that again because it's in your 401k. And that applies across your household. So if your partner did this within their IRA or 401k or Roth IRA or whatever, all these different accounts, like that can invalidate the loss and there's no way to recapture it. You are trading company stock or even individual shares more generally across your tax advantaged accounts as well as your taxable accounts. Just be aware of how the wash sale rules can impact that.
Most people don't know about the permanent disallowance of a repurchase in a qualified account. And that's not just 401ks, it's also IRAs or, if you've got a, 403B or whatever, any of those qualified accounts, anything that's essentially tax advantaged. So the way that this works is if you are selling shares at a loss in a taxable account and you repurchase them plus or minus 30 days, then essentially what happens is the loss gets deferred. And the way that it gets deferred is by adding the new purchase into the cost basis of the existing purchase and the holding period gets extended. So that's a lot of words to say that this thing gets kicked into the future. But, the landmine here, the thing to watch out, the rake in the face, as I like to say for, Sideshow Bob fans out there is just like, if you realize that loss in a taxable account, repurchase in a qualified account or an IRA, then like that loss is gone. Like there is no deferral anymore. It's permanently gone. It sort of makes sense structurally, but it's just something to be aware of if you need that loss in the current year. So if let's say you harvested because you're trying to shut down all those Uber shares that you've accrued, so you're harvesting losses in one end of the portfolio so that you can realize gains in another end of the portfolio and try to net the two. I mean, if you're repurchasing in one of those qualified accounts, those losses are gone. There you go. I mean, okay, Andre, there's one more here. There's one more circumstance. We keep talking about stock.
As expected, when Brent and I are talking about this stuff, we get into the weeds and go deep on this.
Yeah. So, I mean, you wrote about this maybe 18 months ago, but it was just like, look, if you are concerned about concentration to employer stock, you got to look at the meaningful holdings of the underlying indices that you might be buying. If you're buying that big Vanguard fund and you're just like, man, I got to get rid of all my Microsoft stock. Microsoft is a big chunk of that Vanguard fund. And you got to be aware of the amount of risk that you're totally taking. And this is just something to keep in mind all the time.
Yeah. Particularly when you're working at the Mag 8, I'll throw Broadcom in there too, because they fly under the radar, but they're a significant portion of the S&P 500 now. So what Brent's talking about is concentration risk. And that's easy to see. Like, all right, I'm holding specifically these NVIDIA shares and it makes up 10% of my portfolio. And I'm also holding maybe VOO, which is the S&P 500 index from Vanguard, or VTI, which is the overall US market. And you're saying, oh, I have 10% of my portfolio in NVIDIA. But the unknown concentration is that, hey, 7% of VTI or VOO is also NVIDIA. So your true concentration is going to end up much higher than you think. So just be aware, particularly if you're working at one of the companies that are a significant weight in these indexes, is you probably hold even more concentration in your specific company than you might realize. So I refer to that as the unknown concentration risk. And there's a couple tools out there that allow you to piece this apart. Like Morningstar has some. I use a tool called Mezi as another one. But essentially being able to dig into your underlying ETFs that you're holding and see the underlying holdings, and then make sure that you're thinking about your concentration, including that, because I think that's very easy to miss.
Yeah, 100%. So at that point, you've kind of like totally wrapped your mind around all of the risks that you're holding, and you've decided it's too much. I want to figure out a way to get out of this mess. You've backed yourself into a corner. You painted yourself into a corner. There are ways. There are ways. So this is the kind of stuff that I do. If there's like a baton handoff from Andre, who I think does a really good job of retail communication, which is like, hey, these are the things that you should care about. This is why you should care. This is how it works. Then like, that's like when we sort of enter into my world, which is usually on the advisor's side. It's usually on kind of like all the intricate tax mechanics. That's usually how I spend most of my day.
Let me tee it up for you, Brent.
Yeah.
Let's pretend we have an Uber employee that's been at Uber for 10 years, and they're holding shares that have vested over the last 10 years, which have appreciated significantly since the IPO. Maybe they're even holding some shares from before the IPO. And now they're afraid of the taxes. And like the taxes are paralyzing them. Like, oh, if I sell these, like they were given to me at $20 and now Uber is at $100. I'm afraid of this huge tax bill. I'm paralyzed. I know I shouldn't have 50% of my portfolio in this one company, but I don't want to pay taxes either. That's when the situation often happens. So where do we go from there?
I mean, you got to figure out how much risk do you want to take. Some folks are risk seeking and they want to hold a giant chunk of their net worth in a single name, and that's their prerogative. And so I think that's when you have to figure out, just as long as your eyes wide open on it, like how much risk am I actually taking? For instance, NVIDIA's volatility versus the S&P 500's volatility. And you'll just know that like NVIDIA is going to be more volatile than the underlying index. And that's just because the index is the weighted average. But I think the thing that's most relevant here for folks is just like, if you're taking all that risk, maybe Uber is not going to fail, but the main concern here is like, is Uber going to be down, like significantly down when you need the cash? Because you're buying, your first house, you're buying an investment property, whatever, your kids are finally going to college, and you've got that first tuition check due. What happens if Uber is down 50%? And you've got to make that cash payment. You've got to realize. So you'll pay tax, you'll pay tax if you got that much appreciation. You just don't want to experience that much price pain on the way out. And that's one of the benefits of diversifying, is just to eliminate what we call sequence of return risk.
And it's also one too, like I think pre-2020, when everything was just going up and to the right and things never go down, is what it seemed like. It was always kind of like, hey, take the survey to determine your risk. I think now we don't have to do that and say like, hey, how did it feel during COVID when your meta shares went under $100 from their $300 thing, and your total compensation dropped from $500,000 to $200,000 or $300,000? Like, physically, how did that feel? And that's really what you're dealing with when you're concentrated. Like significant portions of your overall net worth and your income are going to take those hits so much more. You can't impact the income side, but you can control the concentration side outside of your income to kind of avoid that.
Oh, but I think you're right. It's not just say, this is the state of my portfolio and I'm overexposed. And yeah, that's painful to watch my portfolio go down, but your comp too. Because your comp is like a direct function of volatility of the market. And you are stacked in terms of risk exposure by your current employment and your portfolio. So you want to balance the two. Your portfolio can buffer what's happening at your company stock.
Yeah, definitely. So what are some of the strategies there? Like, I don't want to pay, or I want to minimize the amount of taxes on it. And it's like, what are the options that I have?
I mean,
I'm getting sold a lot of options. Like, what options do I like? I'm frequently getting messages and saying, hey, do you want to save money on taxes? Do I need to go buy some Airbnbs? Like, what's going on?
The Airbnb, yeah, Andre, what me and you need to do as the sort of free floating spouses is that we need to go get our real estate designations. I knew this is where you were going with this. This is exactly what we're both putting down, everything that we're doing. We're going to dedicate, what is it, 500 to 1,000 hours a year, and half of our professional.
I think that's it.
Okay. So anyway, we're probably not doing that, but there are other ways to reduce risk in the portfolio. And with 4 minutes left here, I want to tease this up as another topic because it's super deep. There's an entire industry that is like, okay, you've painted yourself into a corner. How do we help you get out of this mess? in a risk situation that you're comfortable with. If you want to keep upside exposure, there are ways to do that. If you want to get immediately diversified, there are ways to do that. But I almost feel like that's just such a dense topic. And of course, we
So
could
we're
talk
teeing
about
up
it
for a
forever.
potential episode 2 of the Not Advice podcast.
Yeah, I think that's it. I mean, just knowing that you have layered risk, if you're just a public stock employee, and it's, things get much hairier if you're private, jumping
I think
off
that's a good
plane.
one. The one thing I do want to have as one of the closing thoughts is don't be afraid of just paying the taxes too. I think people get so hung up on avoiding taxes that they leave themselves in suboptimal positions for too long or overly concentrated positions when just paying the taxes and having it done with is a perfectly viable option. Like, yes, you will always want to not pay more taxes than you need to and take advantage of the strategies that are out there to reduce the amount of taxes. But just think through is the return on hassle in a place where it makes it worth it? In some cases, it's just like, let me just bite the bullet, pay the taxes, and then be done with it. I don't have to worry about this ever again. Awesome. If I'm paying tax on a significant gain, like I've done something right. I won on this aspect. Like my concentration bet paid off. I'm in a good position where I'm able to pay these taxes. Just
100%.
again, like don't be afraid of the taxes. And again, what is the common phrase that the advisors like to throw around with some dogs?
Oh yeah, don't let the tax tail wag the investment dog. The professional advice is the same. It says, let's consider just unwinding right away because the risk of down is material. That can be a lot scarier than the known payment of just paying the bill.
Sell the stock, pay the taxes, and diversify is like the least sexy thing versus here's this super complicated investment vehicle that we can utilize and we'll be able to save this amount on taxes if you do X, Y, and Z. Again, and they're perfectly legitimate and they have their places, but just remember that's not the only option. You can also just pay the taxes. That's
just be done with
perfectly
it.
Viable.
I tell people, just be done with this. If this is not a priority of yours, if you're not dogmatic about either the underlying exposure or the tax situation in your regime, just be done with it. And a lot of folks, and this is not advice, and I'm not giving personalized advice. I want to be clear about that. But, if I'm just speaking generally about approach to diversifying concentrated positions, I mean, you should really think hard about just being done with it and getting on with your life.
All right. Check out Brent's newsletter on Substack. He has a lot of good content specific to tax-aware investing and making sure you're optimizing all things like investment tax optimizations. I personally have scratched the surface around some direct indexing strategies, and he has gone 3 levels deeper and is very close with the financial industry where people go to him to get context and the latest on what is the most tax efficient way of unwinding concentrated positions. So I think it will be a good topic for us in the future, but you've also written a significant amount on the topic already.
Yeah, it's just a nerdy interest. And I think the thing that's changed over the past couple of years is that my ties to the industry are much, much stronger now. And so I get people sending me good content and they're partners in analysis now. So I think I've got maybe a unique perspective being an independent analyst on this stuff.
Awesome. So that's the end of episode 1. If you guys have enjoyed this, we'd love to hear it. If you guys want to leave comments, share it with your friends that might be interested, or if you have feedback for us, send it our way. We'll be back for episode 2 at some point. This should be recorded and maybe we'll chop it up and syndicate it to wherever you get your podcasts.
This is Andre. This is fun. I had a good time.
Yeah, no, I had fun.